Right. Effectively, we are continuing our discussion on central bank and the Federal Reserve System. In fact, today's discussion is coming to you as a recorded presentation simply because of my continuous engagement with some very urgent matters pertaining to the my professional engagements. I'm not in a position to have the physical presentation on Saturday's class, but this would be relayed to you all on that basis. And I highlight the importance of this central bank once again, simply because if you have noticed the global attention with respect to the Federal Reserve's decision yesterday. This was announced to the world after the Federal Open Market Committee and the Federal Board of Governors discussion on 16th and 17th of March. And the Fed Reserve's chairman, Jerome Powell, he came out and met the press and had the broader press conference in terms of what US central bank's policy decision with respect to maintaining the status quo of the monetary policy stance. They have not changed the policy interest rates. They are maintaining the overnight policy interest rates, their target range between 0 to 25 basis points, 0 to a quarter percentage point, and effectively signaling their continuity in terms of subscription to the US treasuries and other corporate debt. So that signals the continuity of their stance despite some expectation building in terms of US central bank is returning to an upward adjustment to the interest rate structure. It not the outcome they have announced, and that was widely expected in the international financial markets, and they have again indicated the reasoning. I mean, these are part and parcel of a central bank's policy announcement and how global financial markets look at these announcements from a very broader perspective. And this being said, what you are basically seeing here is the importance that this communication gets in a global financial spectrum, not only in the US, but across all advanced and emerging and frontier developing economies. Everybody was expecting, because this results in global financial movements, and at the same time, the cost of financing involves in overall global financial structure. And this being said, we will continue our discussion. You probably aware the fact that we have discussed about the structure and the brief description about some of the policy tools. One of the policy tools that we discuss in terms of the discussion with respect to the US policy announcement is the discount rate. That's what we are referring in the policy tools here. So they are setting the overnight Fed fund rate in the US, and their desire to maintain it between 0 to 25 basis points, as indicated as indicated at the press conference. But what matters here is the Board of Governors, then of course the Federal Open Market Committee. They had extensive deliberations for 2 days, and they came out with their policy announcement. And what matters here is they factor the inputs from all stakeholders. And as we described last week, we also recognized the distribution of Fed Reserve districts, and we came to explain that most of the Federal Reserve banks in the case of US, where in the US case it's 12 central banks effectively, and the Federal Reserve banks across the country was widely distributed but concentrated heavily towards east coast of the US, simply because at the time of the introduction of Fed Reserve law, you probably see the global financial markets and international trade very much centered across Europe and the east coast of the US, across the Atlantic Ocean, right? So you see number of Fed Reserve banks, number of Fed Reserve branch cities, and then the Federal Board of Governors, Fed Reserve's Board of Governors, they all sits very close to the East Coast, and in Washington, and you also see Fed Reserve Bank in Boston. You see in Buffalo, that is in the New York, okay, with branch cities, and then you see in Philadelphia, and also you are seeing in Richmond, and very much, and also you can see to some extent in Atlanta, okay. So you see these Fed Reserve banks and branch cities very much concentrated into the East Coast. The West Coast was very much a big centralized arrangement in San Francisco for number of US states. And this being said, the US in early 1900s, very much of their industrial activities were concentrated in this side of the country, and also in the mid part of US, there's not much centralization, and you probably see few branch cities and few Fed Reserve banks established across. So in 12 altogether, so you see how this been spread out across the country, and effectively this give the centralized decision-making arrangements within the Federal Reserve's structure. That is one of the elements that they highlighted at the time of introduction itself. Then you are moving on, you see that these Fed Reserve banks are quasi-public institutions. It is not purely owned by the US government, or for that matter, only one type of stakeholder. It's widely distributed in terms of its ownership, and you can see here it's been owned by a combination of private commercial banks in that particular Fed Reserve district. Okay, and they are naturally the members of the Fed system. But interestingly, US banking structure, we will discuss about it in a few slides down the line. So you probably see they have banks concentrated to that state. Generally, you call it a kind of a state structure, not necessarily nationally spread out. So national banks are there, which crisscrosses different states. And then these national banks sometimes even go beyond the US jurisdiction and falls into international financial institutions, where you'll probably see they're operating all across the world. So this being said, the Fed Reserve's ownership structure, it's a quasi-public institutional structure owned by both private and public, but mainly by the member banks who are the Fed Reserve System's members. And then at the same time, when it comes to election of directors to Fed Reserve banks, the member banks elect 6 directors for each district. Okay, and then you see 3 more directors are appointed by the Board of Governors, right? So 3 directors effectively looked at here are professional bankers, and then you see another 3 directors are prominent leaders from different industries. This is also very interesting concept you have to understand. Why? Because certain districts are prominent in some type of economic activity. For instance, sometimes it may be manufacturing, sometimes it might be agriculture, sometimes it might be service oriented. So industry specific prominent business leaders, if not prominent people, being appointed to board of directors, through which Fed Reserves bring in the kind of flavor and the decision making required for that particular district under consideration. Otherwise, if you appoint somebody from another part of the country, probably they fear the fact that they would not necessarily take on board the requirement of that particular district itself. Then also, you see the 3 directors appointed by Board of Governors. But interestingly, these directors appointed are not members in the sense they are not necessarily the employees or stockholders of these member banks. So to see that their independence being looked at, and effectively what it signals is the professional composition of members to the board of directors of each Fed Reserve district, as what you are simply seeing here, right? So with each Fed Reserve bank consists of 9 directors, as you already know, right? And then these 9 directors come from 6 being appointed by member banks and 3 being appointed by Fed Reserve's Board of Governors. So when it comes to Central Bank of Sri Lanka, you probably know the decision-making body is the Monetary Board, which is effectively a 5-member setup as of now. The governor to the central bank being appointed by the president with the concurrence of the minister in charge of the subject finance, right? So then you see ex officio, by holding the position of secretary to the treasury, effectively the secretary to the finance ministry, is a member of the monetary board. And then you see 3 more members, they are independent members appointed to the Central Bank of Sri Lanka's monetary board, effectively with the concurrence of the finance minister. But these appointments are also channeled through the constitutional councils in the parliament. So you generally see the specification in terms of monetary board, where we are not necessarily a largely distributed, highly diversified, effectively spread out and resourceful economy. And Sri Lanka is generally concentrated in terms of its western province in terms of economic activities. And it's not necessarily distance-wise also widely distanced from the center of financial operations to have a general access. And this being represented to some extent. And what we see in Sri Lanka's case is not necessarily you can call it like branch cities like Fed Reserve, but you see regional officers, if not regional operations of the central bank carried out through few regional arrangements. And there are few regional arrangements, but not necessarily carrying out major central banking operational element, but more or less engaging a regional related regional development, rural development related, and then statistic and information dissemination related, and also general communication related activities in the periphery. So that's how the Sri Lanka is set up in terms of the center and the branches spread out across the country. And then you move on. What you are basically seeing here is member banks, as we were highlighting, select or elect 6 directors for each district, and the balance 3 are appointed by the Board of Governors. Okay, and effectively they also look at in terms of some reflection in terms of constituencies where the Fed Reserve districts represent in terms of the constituencies of the public. Sometimes you call it in terms of their nationality, Hispanics, right? Then, of course, the Native Americans. Native Americans, you call it all in a different way, in type, in different cases. But what you are basically seeing is the representation in terms of the locality being prioritized through appointment of these board of directors, and they factor that in their constitution of board of directors, right? So all these directors appoint the president. Among these 9 directors, you see, they appoint the president of the bank, and this president's appointment again get cleared by the board of governors. They are sitting in Washington, D.C., right? So among these directors appointed, one become the president, effectively the head of the Fed Reserve Bank, and he been cleared by the board of governors. In the Sri Lanka's case, you know, it's the political appointment appointed by the president with the concurrence of the minister in charge of the subject finance as the governor, and he is the chairman of the monetary board and effectively run as the CEO of the Central Bank of Sri Lanka. Okay, so that's how the structure in terms of the board of management and the monetary board that I was explaining to you. And then you see the functions. The central banks perform quite a lot of function. I mean, very broadly, you could conclude and pool these functions into mainly 5 functions, but it's not sometimes right to restrict it to 5, but you can see. Okay, so Federal Reserve System performs 5 functions. We'll come into that in details as we discuss this section. You can pen down if you have any questions and share that alongside the chat structure while you are listening to the presentation. So I can follow it up when I see you all in the following class. So what you are basically seeing is the Fed Reserve System and the 3 key system entities. You know, Fed Reserve System performs now 5 key functions, right? In the public interest to promote the health of the US economy and the stability of the US financial system. So broadly, they are looking at health of the US economy and the stability in terms of the financial system. And then the 3 system entities, you know, the board of governors, right? The Fed Reserve Banks and the Federal Open Market Committee. Okay, they work together to promote the health of the US economy and the stability of the US financial system. So what you are basically seeing here is this is structural. But when it comes to functions, what the Fed Reserve or the central banks perform across the world, you can broadly bring in these 5 functions to explain. So what they do is they conduct monetary policy. Okay, they come to the conclusion that the Federal Open Market Committee, FOMC, sets US monetary policy in accordance with its mandate from the Congress or from the Parliament, okay, to promote maximum employment. Maximum, remember, the maximum employment, effectively what it signals is that the Fed Reserve has the mandate to promote full employment in US. Full employment does not mean 100% of the labor force is employed. There's a natural rate of unemployment in any circumstances. Taking out that, the rest needs to be employed. So the central bank in US, Fed Reserve, will do everything to achieve this objective. Then they look at stable prices, inflation, effectively stable inflation, in a sense, what it means is low and stable prices. You can't expect inflation to be always one level. No, inflation adjusts slightly here and there, but at times it adjusts significantly. It even leads to very high inflation. But the objective here is to maintain more or less low and stable inflation. Stable prices means that. And then they also expect moderate long-term interest rates in the US economy. Not necessarily short-term interest rates effectively being looked at, but through short-term interest rates, you adjust the market expectation in terms of other macroeconomic variable, and you see here a moderate, not high, not low interest rates for the medium term. Okay, so what envisage here is effectively the US central bank's objectives. And in case of Sri Lanka, what it entails in terms of the Monetary Law Act is, right, economic and price stability. Price stability is no different to stable prices, but what it is effectively signaling in the case of Sri Lanka is low and stable inflation. And Central Bank of Sri Lanka, through its various publications and discussions and interaction with the stakeholders, highlight the expected inflation level that they would be happy to see is 4 to 6% as of now. But remember, in the case of central bank's MLA objectives being defined, it's not only the price stability, but economic and price stability. So invariably, the Central Bank of Sri Lanka also look at economic stability. That to say that the productive resources in the economy being employed, right? So stability in terms of economy, people should have employment, people should have access to resources, people should have reasonable income generating economic activities being promoted. So central bank facilitate in the case of Sri Lanka too, economic and price stability. And then the second objective in terms of its statute, that is the Monetary Law Act, is the financial system stability. Right? US bring this in terms of outside the conducting of monetary policy. They also promote financial system stability, but when it comes to Central Bank of Sri Lanka, it broadly specifies the achievement of economic and price stability as one of the objectives. Second is financial system stability. That to say that the financial intermediation has the stakeholder confidence, and the central bank would do everything to protect the financial system in terms of its overall stability and contribution to the economy's welfare. And in the case of Fed Reserve, what you are now seeing is 5 functions that we were talking. One is conducting monetary policy. The promoting financial system stability is the next. The Fed Reserve monitors financial system risk and engage at home and abroad. They not only look at their home base, the jurisdiction within which US operates. No, they even look at abroad to help ensure the system supports a healthy economy for US households, communities, and businesses. And their financial system stability objective is much broader in that sense. It's not only restricted to the jurisdiction in which US operates, but even beyond that, through which any spillovers they keep a close eye on. And for countries like Sri Lanka, it's also affects when it comes to overall financial stability, financial system stability maintained by US and major markets around you, because that would have spillovers. Right? There's no difference then in terms of what we do and what they do, but their focus is much broader in terms of conducting monetary policy and financial system stability. They go very much beyond their own peripheries, where in our case, we are in fact receivers of what happens elsewhere, rather than we are the influencers of what to happen across the rest of the world. So that comes with economic power that you vest with, whereas US remain the biggest and most influential economy still to date in terms of all these engagements. And the other Fed Reserve function is supervising and regulating financial institutions and activities. The Fed Reserve promotes the safety and soundness of individual financial institutions. I remember I was talking with you all about micro prudential supervision, and monitors their impact on the financial system as a whole. And I remember I was mentioning not only the micro prudential, but also macro prudential supervision. So please see that elements here: individual financial institution and financial system as a whole. Macro is as a whole. Micro prudential requirement is the individual financial institution, as what they are explaining here. And Central Bank of Sri Lanka also supervise the licensed commercial banks, the primary dealers, and licensed finance agencies, finance companies in its jurisdiction. They also look at now, to some extent, some guidelines in terms of microfinancing, but broadly that's not the supervisory role central banks play, but central bank sets its broader guidelines and the system specification in case of Sri Lanka. And then the fourth function that central bank, Fed Reserve System performs is fostering payment and settlement system safety and efficiency. You see, Fed Reserve work to promote a safe, efficient, and accessible system for US dollar transactions. I mean, it's not necessarily the payment and settlement in terms of the currency issued alone. There are electronic, there are various other sophisticated platforms that require people's attention, and that's become very significant and important, especially at times of the global difficulties like COVID-19 pandemic. The attention of world has appreciably concentrated in recent times towards new payment and settlement structures, and also the safety and efficiency of such structures. And there's no different, even the Central Bank of Sri Lanka carries out the payment and settlement function, and they have established online real-time gross settlement structures, and now they are looking beyond so-called gross settlement. They are looking at net settlement possibilities, and they are working through a capital market development project. And it's a very important element in today's context that the central banks all across the world is looking at these payment structures, because the global financial system integrates with each other. You cannot kind of concentrate only within your country and jurisdiction and talk about payment arrangements. No, the central banks are increasingly and broadly now concentrating among themselves and among financial markets to bring in all type of payment structures and settlement structures through which to increase the efficiency and safety of financial transactions. And then you see the other major function this Fed Reserve highlight is promoting consumer protection and community development. The Fed Reserve advances its supervision, community reinvestment, and research to increase understanding of the impact of financial services policies and practices on consumers and communities. Yes, they don't restrict broader structures to the financial stakeholders or the financial industry alone. They look at broadly the impact of such on ultimate consumers, the individuals, general public, and the communities as a whole. And in fact, this is very much in terms of the protection and safety of many other advanced features of the structures prevail and the legal systems prevail in US. But effectively, this is now being accepted by even emerging frontier developing economies like Sri Lanka. We too have, in fact, introduced a consumer protection, if not the financial intermediation driven the consumer or the customer protection department in the Central Bank of Sri Lanka. You can access the Central Bank of Sri Lanka's website and read through its introduction and its purposes. So the community who has difficulties and requirements in terms of understanding the central bank's functions, roles, and even to the extent that there are complaints with respect to their requests from financial intermediaries or from the central bank being channeled to this particular department now formed in the central bank, and through which they can again address number of elements that they are looking at. And you can now see everything being said in terms of Fed Reserve System and its major functions is no different across other central banks also. And you can conclude even in the case of Central Bank of Sri Lanka, they also perform, they also effectively look at achieving the desired objectives under these functions that we were discussing. But the magnitude and the depth and widespreadness of these in the case of Sri Lanka differs to the global financial giant US financial market. So that comes with the maturity and the financial acumen of all stakeholders in any economy. And we are also moving in that direction. But what you are basically seeing is while we approach US and advanced economies move very fast in terms of some of these elements. But we also will feel those changes and we also would require to adapt. So what you are basically looking at is more or less the central bank functions across US is actually at times leading the rest of the world to follow suit in terms of the expanding global financial architecture. Right. So then you more or less go into a little more nitty-gritties in terms of the sum of the underlying functions that you will be very straightforwardly will understand. The central banks and the Fed Reserve, for that matter, does these functions. These are very straightforward. They clear checks. But it's effectively what they do is, in most of the cases, they establish private entities. For instance, in the case of Sri Lanka, we have so-called Lanka Clear Private Limited. That basically settles all the checks between financial intermediaries, the banks, right? But end of the day, through that, the arrangements goes back to the overall accounts maintained with the central bank where the credit debit transactions happens. And apart from the check clearance, checks are written instructions of movements of funds from accounts maintained with financial intermediaries, right? So written instructions, that's checks. right? You know what it is. Then another very important functions everywhere the central banks perform is issuance of currency. Right. The issuance of currency also takes a very important and significant role. And in most cases, across the world, this being empowered to central banks. But there are one or two cases where the currency issuance still being maintained separately for certain reasons. And some countries do not have currency issuance independence. They actually maintain, if not use another currency, another country's currency, US dollar at times, right? So you see this new currency issuance, and there you see it's important to maintain the safety as well as the durability of the currencies printed by the central bank. So there are various efforts in terms of achieving these objectives, and also the central banks in terms of the currency management also take efforts to withdraw damaged currencies from circulation, and damage not only damaged ones, but you also call mutilated. Okay, so you may kind of deface the currencies for various reasons. So that also being taken out from the equation, because effectively what it signals is a clean and clear currency in circulation would actually enhance the acceptance and the reputation of a country. And through this, they have taken a number of initiatives in recent times. You've probably seen in the case of Sri Lanka, the central bank has performing so-called withdrawing of damaged and mutilated, and also they would not necessarily replace willfully mutilated currencies, and also kind of willfully defacing currencies is a punishable offense. And the efforts through which that they have achieved this is now by people themselves segregate them and hand it over. They have given a period to kind of adhere to this, and that has reduced the central bank role in terms of engaging in withdrawing damage and willfully mutilated, if not defaced, currencies from circulation. It is also a tedious task, but general public, they themselves perform this. Financial intermediaries, they themselves perform this. In the case of Sri Lanka in recent times, you've probably seen the advertisement in wider circulation, and you walk into any financial intermediary, you see the advertisements with respect to this, and they have taken out these from circulation, right? And the facilitation is that these currencies can be brought back and exchanged for new currencies, and through which that get out of circulation and then this been destroyed. Okay, and another function the central banks perform, Federal Reserve performs, is they administer and make discount loans. Okay, so the banks can access to the central bank and obtain financial facilities, and they have discount windows. They have open market operations. They facilitate discount windows. In a way, this is a lender of last resort kind, but this cannot be concluded as lender of last resort. This is a general facility. If you really want a lender of last resort, you have other facilities. When everybody else is not ready to extend you, the central bank is still ready to extend you some facilities to make sure you actually functions and you take appropriate measures in terms of mitigating your risk elements. So the central banks would extend these administrative structures and discount loans to banks through their operations in the Federal Reserve districts and their branch cities in the case of US. And in the case of Central Bank of Sri Lanka, you see these being extended through its operation in the head office and mainly to the banks and primary dealers. They can have these facilities avail for themselves. At times, under the collateral schemes, you had to subscribe to collaterals and mainly the government securities, and they extend these loans, and you could have these loans settled. And you see, sometimes these facilities are intraday and interday. Within the day intra, often these facilities are free of cost. The banks do not necessarily require to pay. They can obtain some of these facilities in the morning and then settle before the close of usual timelines during the day itself. So there would be no charges. But you also have interday facilities, overnight facilities, term facilities. These are the discount lending to these institutions. Of course, then you have to pay the overnight interest rates to the central bank. And then, of course, the Fed Reserve and other central banks evaluate, propose mergers and application for banks to expand their activities. These are now not necessarily a significant function in terms of what central banks does, but still they keep a close eye on efforts for financial consolidation and related mergers and a kind of a new expansion into new territories of economic activities. And this is another element the central banks perform as a more kind of a direct function in today's sense. And then central bank or the Fed Reserve act as the liaisons between business community and the Fed Reserve system. Yes, the business community would be one of the main stakeholders in any financial structure, financial system, and the economy. And the Fed Reserve or the central bank across the world, even in the case of Sri Lanka, the central bank act as a liaison between them and the banking industry, entire financial system in the country, and they themselves take note of business communities' requirements of observations and things like that. That's very important for a evolving and efficient financial system, right? So the business community would bring in new ways and means to increase the efficiency of financial systems, the operations of central banks, the financial system as a whole. But this requires a continuous engagement by the central banks and the relevant stakeholders like business people. So this happens everywhere. Okay, and also the Fed Reserve and the central bank, for that matter, they examine as a part of their supervision or as a part of the requirement base, they examine bank holding companies. They look at what type of businesses that the bank is expanding into, whether they are permitted. They sometimes do not allow banks to get into certain type of activities. Okay, and also they look at, in the case of US, state chartered member banks. It's the banks again licensed by the Fed Reserve to operate within that Fed Reserve district. So they are allowed within, not outside. So there are a number of banks in US, a bigger number of banks. Their operations are limited to the state in which that they are operating. So they examine their activities too. But in the case of Sri Lanka, there is no such limited, restricted kind of arrangement. I mean, any bank, any financial intermediary who get the license, they can operate across the country. And in US, it is state chartered, nationally chartered. There's a difference, right? So then the information, we know the trouble of asymmetry in information, and the information remain one of the most important element of any financial markets. So the central bank and the Fed Reserve, for that matter, collect, pool this information, and keep a very close communication of these informations to the rest of the world. Okay, and they also engage professionals, economists, and financial experts, and do research on different financial and economic topics, and this being used for the conduct of monetary policy as well as other functions that we were discussing in one of the slides a little while ago. So basically, you see the engagement of professionals in their activities. So this is also very important in the case of US as well as across other central banks in the country. Okay, and then you see the Fed Reserve Bank and monetary policy, very particularly so-called directors of Fed Reserve banks in different Fed Reserve districts. They are the ones they establish the discount rate. Okay, but the broader overall Fed Reserve's monetary policy, a directed discount rate, and the levels being cleared by the Board of Governors and the Federal Reserve Open Market Committee, FOMC. And within that, yes, there may be slight variation in terms of how it's been applied across different states. The directors establish that, and they decide which banks or which stakeholders can obtain these discount loans from the central bank. So when they require these funds, what type of institutions? Mainly the member banks, they can have access. But at times of financial stress or difficulties, these being extended beyond the financial intermediaries or the member banks in the case of US recent experience is concerned. The financial crisis in 2007-9, probably they have extended these facilities to other stakeholders as well. Okay, and then of course these the board of directors, they select one commercial banker from each district to serve on the Federal Advisory Council. You know, in the case of US Fed Reserve structure, the advisory councils also exist. Okay, so the advisory councils, they interact with Board of Governors, right? So the advisory councils comprised of one commercial banker from each district, and that they serve on the Federal Advisory Council, and they get interacted, and the Board of Governors consults them, and these advisory councils members provide information, feed them with the developments on the different states in the case of US, and which helps information and other related details being shared with Board of Governors in terms of its conducting of monetary policy. Okay, and then the composition of FOMC, you know, it's 12 members, 7 members coming from the Board of Governors, all 7 members, and then 5 presidents representing different districts. And US, in the case of US, you know, naturally, the New York Fed Reserve president is a member of the FOMC because that's been the epicenter of global financial markets. And then the 4 other presidents on a rotational basis out of the 11 other Fed Reserve banks get elected to the FOMC, and that makes the 7 plus 5, the 12-member FOMC board. That's the board through which most of the time the policy decisions and the monetary policy implementations being discussed and decisions are arrived. So what you are basically seeing is the central bank in the case of US and the conduct of monetary policy is very clear from a very broader perspective from this slide itself. But what you have to understand here is in the case of Sri Lanka, the licensed commercial banks and the primary dealers can have access to discount rate. Very rarely we have seen this arrangement has been extended to other economic stakeholders, right? So That's due to various explanation, various reasons in the case of Sri Lanka. But through them, others can access. Through them, others can have financial facilities engaged and arranged, because you can have an arrangement with your banker. That banker would facilitate you. But when he requires such facilitation from the central bank on the basis of prevailing market circumstances and his own circumstances, he can access the central bank's window or open market operation or other established lender of last resort facilities. So that's the way in which the central banks perform mostly across the rest of the world. But they do open market operations, buying and selling in the general market, the financial assets, mainly the government securities. And at the same time, they do a signaling in terms of expectation and carry out a lot of research related work in terms of overall decision making and information dissemination per se. So you can see the elements behind the Fed Reserve and its conduct of monetary policy from that side. So then you see the member banks. And in the case of US, all national banks, that means the banks who have its operation beyond its boundaries of a Fed Reserve district. So they are national banks. They require to be members of the Fed Reserve system. Then you see commercial banks which have been chartered by states. We have recognized in the case of US, the banks are either chartered by states or by the broadly by the Fed Reserve in terms of its national operations, right? So that means few states for that matter. This state-specific commercial banks, they do not require to be members of the Fed Reserve system. They can opt to be not, but they can also become members, because through which they all have other facilities and other engagement, and also in terms of information with respect to overall economic health and the directions would be fastly accessed. And you also have access and also a contribution in terms of building required information symmetry in those markets. Okay. And then also member banks have depository institution deregulation and monetary control related specifications through legislation. Okay, all the banks are subject to these, right? So they have to have depository institutions to some extent deregulated and control being introduced for safety of members. Okay, and same the financial institutions here comes under reserve requirement, where the central banks impose on member banks that out of all deposit mobilization, you need to maintain a certain percentage. And in Sri Lanka's case, it is 2% now. Often it's very low in the case of US. And Sri Lanka also now maintain a very low reserve requirement. And also, the members have all the facilities, like, as I was mentioning, open market operation, access to discount windows. They do not necessarily require to pay any fee if the financing being facilitated for intra-day, that is within the day, but inter-day or term basis also, the rates at which they access is often very much competitive than the markets. So otherwise you can go to the market and access it, but at the same time market would not be lending you because they have exposure limits. The bank A would say to bank B, no, I can only give you 100 million. Beyond that, I can't take the risk of your borrowing. So they might not necessarily lend. But when it comes to a member bank, they can come to the central bank and they can borrow any amount of money by providing collateral, right? So that itself produce and provide you with substantive facilities and other related access, infrastructure, different paying platform, information, representation, all is facilitated to member banks in terms of the central bank's facility provision, and this is no different to Central Bank of Sri Lanka. Everything I said about Fed is true when it comes to banks and financial intermediaries who are licensed by the central bank in the case of Sri Lanka. Sri Lanka's financial market is concerned. Then very specifically, if you look at the Board of Governors of the Fed Reserve System, right? It's 7 members, you know that, and they are concentrated, if not headquartered in Washington. Okay, and they are appointed by the president and confirmed by the Senate. That's the parliament. And interestingly, please see, they have their appointments for a 14-year. It's a very long time in terms of a career, 14-year, non-renewable. So if you complete 14-year, you will not have a second term. But it's not necessarily the total duration that everybody is functioning, because they can resign and go out prior to the expiry of their full 14-year term. That's their discretion. But when it comes to the term specification of Board of Governors in the US, this is a very, very important element that sets independence of the members. Okay, unless they resign on their own, it's very difficult to get them to leave out. I mean, the process in terms of taking out a member once appointed, it's very challenging. But in the case of Sri Lanka, it is in terms of number of years, it is 6 years and can be renewable. Okay. And from the Board of Governors perspective, the 7 members, they have to come from different Fed Reserve districts. You cannot see everybody is coming from Washington, D.C. Cannot find a kind of, everybody is concentrated from a single district. No. They looked at it in terms of wider decentralized decision making in central banks, Fed Reserve systems, the Board of Governors. That's one of the key elements at the inception itself. They were arguing and they were not favoring for a central bank because of their a decentralized decision making prevail under different state environments at that time. So to facilitate that, even the Board of Governors, they have kept it's been decentralized, not letting members coming from a single district. It's been from different districts. And then a chairman, a head of the Board of Governors, been chosen from these Board of Governors, and his single term as a chairman is 4 years and can be reappointed. Many people who have been performed this function for many times as chairman or the governor of the central bank. In the case of Sri Lanka, a single term is 6 years and he can be reappointed. And the monetary board members single term is 6 years, but they can resign if required. That's a different arrangement. But what you are simply seeing here, longer duration facilitate that the continuity of policies, and you are not necessarily subject to the political authorities in power, because you, in the US case, the usually president's term is 4 years. Generally, the Senate's term is 4 years. In the case of Sri Lanka, it is a 5-year term, and then of course, even if there's change in the case of US, some continuity in terms of the policies being practiced in terms of a longer duration of members in the boards, the board of governors. So that's a very interesting element. We will come to this as we move along with this discussion. And then what are the duties of these board of governors? And they are the members who has the voting rights in terms of conduct of open market operations, whether to buy, whether to sell, whether to increase interest rates, decrease interest rates. Okay, they can decide, they can discuss, but often the central banks all around the world appears to function through consensus. They try to function that all the members tend to kind of come to a amicable solution in terms of the decisions that they are arriving at, but that does not mean that they can't have a different view. When everybody wants to increase the rates, there may be people, they might still wanted to either maintain or decrease the rates. They can have that flexibility, because that's how the brainstorming and interaction happens in terms of economic priorities being looked at. And then they see, the board of governors, they see the reserve requirement. They set whether it's 3%, whether it's 1%, by having taken number of factors into considerations, they can set those reserves. Those reserves are often non-remunerated. Central banks do not pay interest for reserves that they keep from member deposits. Central banks do not pay, but at times they pay too, remunerated reserves. But generally, no. In the case of Sri Lanka too, the reserves are not compensated, non-remunerated reserves. Okay, so even in the Central Bank of Sri Lanka's case, the members could vote. Generally, they come to conclusion on consensus. That's what we also have seen. Then they have this discount rate through review and determination process. They controls the discount rates applicable for discount facilities extended through discount windows by the Fed Reserve banks through review and determination process. Generally, border parameter being set, within that some flexibility being given for states to define what's the discount rate applicable, but they monitor with the market developments and determine where to and how best to accommodate them to facilitate the overall objectives of the Fed Reserve System and the central banks across the world in a similar fashion. The margin requirements. It's not necessarily something frequently looked at, but margins for financial transactions or international transactions, they set. For instance, in the case of Sri Lanka, recently, when it comes to imports of certain type of goods, 100% margin was imposed. Imports of motor vehicles, you had to keep 100% of the required finances in the form of deposits. So to kind of manage your external account possible volatilities. Then the margins could also be for financial transactions, the hedging, the derivatives that you are entering, and the requirements in terms of minimum collateral haircuts to be produced. Haircuts in the sense it's not that you are shaving off your hair, but it's a certain percentage of assets value being kept aside for market risk, market volatilities in interest rates when you are making collaterals, when you are making use of these collaterals into overnight lending or whatever facilities central bank extend to the financial intermediaries, you require to have these elements. And also the administrative decisions in terms of salaries, wages to the employees and the budget. These things are common. I mean, this is again the board of directors, if not the board of governors in the case of US, and the monetary board in the case of Central Bank of Sri Lanka. They set these things. So you see these elements being played significantly in the case of US as well as in other central banks all around the world. And then the board of directors, if not the board of governors, also makes the final call in terms of mergers and application for new activities. Yes, it's not different in the monetary board in the case of Sri Lanka too. They're the ones they facilitate consolidation of different financial intermediaries. What new activities being cleared, what new activities being not facilitated. It's a decision by the board upon deliberation, right? So then also they looked at what type of holding companies and what type of activities being permissible, right? So certain activities which could be triggering higher risk to the financial intermediation and also increase the possibilities of colluded behavior in the market and not in line with the best standards of practices in financial markets in terms of safety and soundness, they probably be looked at them in terms of permissible activities. They could give them the flexibility, or they might not be allowed to perform such activities. And also the Fed Reserve look at and they supervise the operations of foreign banks in the US. Now, if you look at the bank sizes in today's context, the biggest banks in the world are mainly China-centered Chinese banks. And they are the biggest ones now. And about 20 years ago, the situation was somewhat different. And fastly, with the international trade and emergence of China as one of the, it's the second biggest economy, it's fastly catching up the US economy in terms of the size and value, and actually the speed in which they are growing, they would overtake US in few years' time. So the banks operating in US from rest of the world being supervised and monitored and permitted, and their activities being closely evaluated by the Fed Reserve's Board of Governors. They give the operating instructions in terms of one of the functions we discussed, supervise and regulate financial intermediaries. And this is no different in the case of monetary board when it comes to operation of international financial intermediaries in Sri Lanka. They too requires the monetary board's consent clearance in terms of their activities, and they also being subject to the supervision and regulation. And I believe there's no difference across the rest of the world too, except maybe the way in which they operate them maybe differ based on the expertise, the level of complexity, and the infrastructure, and the people involved, and the type of economic activities kind of remain as priorities in those economies. Right. Then the chairman, the individual who comes in front of the media often and express the decision and rationalize and take the message across the rest of the financial market is the chairman, and often the governor in the case of Central Bank of Sri Lanka or his delegated authority. And this again depends on number of attributes. If a governor is a very good in communication, the effectiveness of communicating the policy decision becomes much more easier and effective. And there may be circumstances the people who hold the position of chairman or governor would not necessarily be effective communicators, but very talented and very capable, technically sound administrators. So then the role of their communication becomes somewhat different. But the role of these heads of these institutions, either chairman of board of governors, or governor of the Central Bank of Sri Lanka, or the governor of the Reserve Bank of India, they generally have the advisor to the government role. The central banks are the economic advisor and economic agent of the government. So they advise us the government in power, either president or for that matter, prime minister, on economic policy. Sometimes the advice may not be heeded by the political authority. They might go with their political priorities in terms of the agenda through which that they have come to power, or they have produced as their policy statement at the time of elections. But the central banks or the chairman of the board of governors or the governor of the central bank has the responsibility to advise on economic policy, whether the elements highlighted could be detrimental to the economic well-being, or in the longer or the medium term, whether that has implication to the overall economic policy. And they go and testify in the Congress or Parliament and different committees, for instance, COPE, COPA, select committees, the presidential commissions. Yes, they go and testify on behalf of the Federal Reserve, on behalf of the Federal Reserve and the Board of Governors, or for that matter, in the case of Sri Lanka, for the Central Bank of Sri Lanka and its relevant departments. And they speak to the media, as I was mentioning, as a part of the communication exercise. Then also they represent their country. The chairman of the Board of Governors go and represent US in negotiation with foreign governments on economic matters. And on multilateral agencies, you see G7, G20, different summits that you see, and the chairman of Federal Reserve also often a member of the delegation of the US when it comes to economic policy matters. And even in the case of Sri Lanka, that too happens, but not necessarily in terms of the negotiations with on a regular basis with foreign governments, but generally he also represents, particularly on economic matters. Then you see FOMC, Federal Open Market Committee. They meet 8 times a year. That means 1.5 months apart, they meet. They set the timetable for meeting, and that's been publicly announced. The rest of the world, rest of the market, keep an eye on these timelines. The FOMC meets and the decisions being announced to the world, because that has significant influence over the overall financial health and the overall financial markets. And in the case of Central Bank of Sri Lanka also, we also have monetary policy review calendar that's published in the central bank website. Okay, monetary policy reviews, we have 8 monetary policy reviews per year. Right? So Sri Lanka's case also market awaits this decision, but this does not mean the Federal Open Market Committee or Monetary Board in the case of Sri Lanka do not have flexibility to meet outside this time intervals. If a requirement arises, they have the flexibility to have the decisions being taken and communicated to the financial markets or the stakeholders as and when required. And FOMC, you know, 7-member board of governors, then 5 presidents of Fed Reserve banks, including the president of the Fed Reserve New York. Then, of course, chairman of the board of governors is the chairman of the chair of the FOMC. And even in the case of Sri Lanka, monetary policy committee is there. The chairman of the monetary policy committee is the governor, and he is the governor of the central bank as well as chairman of the monetary board. Right? So the FOMC also issues directives to the trading desk, mainly to the New York Fed Reserve. So they give directions to the trading desk to inject, absorb the quantities required, volumes that you require to work on. And you look at yesterday's Fed Reserve Chairman's announcement. I mean, they wanted to actually buy every month the US treasuries, US government papers up to about $80 billion. So injecting a liquid to the market, and also another 40 billion for corporate assets. So you can see the magnitude in which that they wanted to engage with the market. So these decisions are arrived by the Federal Open Market Committee in the US case, and similarly, the monetary policy operations in other countries also being guided, directed by the respective boards. Then these meetings, the managers of the system of open market operations, foreign currency, domestic operation, other related issues, they report the developments to the FOMC meetings. What's happening in the market, domestic market, international market, the foreign currency market, okay, and other related economic issues, the oil prices, the commodity prices, what happens to the growth prospects, what happens to the demand across the rest of the world, the inflation expectation, these been present. Then the presentation on board staff national economic forecast. The Federal Open Market Committee also gets the feedback on overall national economic US economy's direction, what's challenges, what risks, how the rest of the world's demand. There are many ways through which these been factored in. And they look at different scenarios for monetary policy actions. If the interest rates increase, decrease, maintain through other various ways of reserve adjustments, open market operations, increase in liquidity, decrease in liquidity, they look at all these things. And then the congressional parliamentary actions, what the broader government directive, what the expectation of government, and what the other policies, like for instance, the fiscal policies directions, what they are trying to do, whether that would improvise, if not jeopardize your policy decisions. They look at all these things. And then the public announcement about the outcome, the detailed minutes of Fed open market operation, FOMC, being widely read and widely looked upon by the rest of the financial market. You can get feed and get some hints about what they're trying to do going forward, what preferences been highlighted, what risks been communicated. And these been publicly announced by the chairman. And Central Bank of Sri Lanka also conducts these through various public announcements of the decisions, press conferences being made, conducted on a regular basis, and directly response to the queries. They have conference calls being arranged across stakeholders at different intervals by key departments on a regular basis. The publications being put out, and that carries the message to the economy and economic stakeholders. And why the chairman of Board of Governors? Why he wants to run the show? And it's very important because his message is very much on the basis of the rationality, and remains the spokesperson for the Federal Reserves. And also he negotiates with the government and the political authority, no different in many countries, including Sri Lanka. And he sets the agenda for meetings. Yes, monetary board meetings agenda is also cleared by the governor. And when it comes to critical decisions and generally for other related matters, he speaks and votes first. Then others falls in line. Often they understand what's the thinking of the chairman, but it's not necessarily something you need to follow. You can be you can have a different view, but you can understand what's the thinking of the chairman in terms of the decision at hand. And generally supervisors and advisors, all economists and other professionals, advisors who works for the central banks. This is no different. Even in Sri Lanka, it's the case. Even in India, it's the case. Even in the UK, it's the case. That's how it is handled. So then the independence of the central bank. How independent is the Fed? When it comes to independence, it's very challenging. I mean, if you look back about a year or so ago, even in US, there was a significant tension between the Fed Reserve Chairman and the Fed Reserve Board of Governors and the political authority. The open criticism from political authority of actions that the Fed Reserve is not carrying out in line with the political authorities' directives. And that itself signifies the goal and instrument at hand. What type of tools that you have in your hand, that's the instruments that they are talking, to carry out the required objectives empowered upon you by the legislation. That's the goal independence. You can have your goal, and carrying out that goal through different type of instruments that you have with you would set this independence that you are looking at. And then the central bank independence also depends on how they generate revenue. If you rely on your revenue to come from government's budgetary allocation, you always tend to fall in line with the government's thinking. It's not the case. Central banks all around the world have its independent sources of income. They manage reserves. They actually do the currency management through which that they generate income. They also conduct open market operations, and they buy assets through their currency printing probabilities. Yes, they know it's inflationary at times, but they manage with the level of inflation and the requirements of the economy in terms of liquidity. So they have generally a very independence in terms of revenue generation. But if you lose this independence in terms of revenue, you would not be able to perform independently. And then one could argue, okay, the structure and the objectives, all that you follow is written by the Parliament or the Congress. So this can be changed by the Congress at any time. And that's possible. But generally, if you tend to adjust something which has merit and rationality, then you get resistance. And at times, some legislations being empowered, it not be easy, where you might require two-thirds of parliamentary approval and kind of things. But yes, the legislation can be set. You cannot actually argue on that basis. But end of the day, the legislation with respect to operations and the central banks need to reflect its independence, as well as how the functions of the central bank ultimately benefits the economy and its stakeholders. And then the influence coming from political authority. In the case of US, how the presidential influence comes to the central bank's operation. This influence on Congress, that's the parliament in the case of Sri Lanka. Appointing members like Board of Governors, right? Appointment of governor or the chairman in the case of Fed Reserve, right? But again, I mean, what is interesting here is when it comes to appointment of chairmen and the term of US, a Board of Governor members, terms of 14 years, look at, it spreads across many terms of a president, because the president's term is 4 years. So that itself sets, you have independence in terms of you are carrying out your obligations and duties, right? So the other countries, it varies to some extent, but generally favors more independence in recent times for central banks' operations. Should Fed be independent or not? I mean, this is a very important and I mean, repeatedly followed question, not only in Fed Reserve, but even in Sri Lanka and other financial markets, other countries too. Because at different time intervals, the importance of this topic become significant in terms of overall economic health and economic well-being across the medium to long term of any country. So there are cases for independence and there are cases against for independence. Okay, so the case for independence broadly come in terms of the strongest argument for an independent central bank rest on the view that subjecting it to political pressure would impart an inflationary bias to monetary policy. Very simple. The inflationary pressures would be greater if you do not have independence, because the political pressure would be there for central banks to pump money, pump expenditure, print money to kind of, make the politicians' life easy. But the business cycle of political authorities and the business cycles of economies are not the same. So this is an ideal point. We can stop our discussion here and you can go through the recording as I was explaining at the very beginning, as today's session was mostly a recorded one. And we will take up the independence as the point to start in our next discussion, and very interesting topic, very timely topic, and often been also recognized in question papers. So we will see this point in our next class. From this point, we will start our discussion, and we might have another very important area, that's a money supply process, also to be discussed in our coming lectures. Thank you and stay safe.